Hey there, Inside Edge investors. Todd and Kyle here. Welcome to Market Video Update. Kyle, we're just laughing. Couldn't have any intro music today because YouTube wrote us a nicely, reasonably worded little message in our video. You can't even play like any music in the background. I was playing the band Cripple Creek before, and they wrote a nice little message. That's copyrighted music. It's like, okay, no problem. Anyways, hey Kyle, how you doing? Happy Monday.
Doing great. Yeah, we'll have to come up with our own music somehow.
Yep. We got to find some music. But how you doing, man? All well?
Doing great.
Good.
Yeah, all is well.
Good. Well, we got a lot to talk about, and we're really trying to settle in on a regular schedule with these. I know you would appreciate it. We are working closer and closer to a regular schedule. We put a lot of work and a lot of research in, and sometimes deadlines sort of get pushed back, and that's entirely on my end. So apologize, but I certainly think we're getting some degree of frequency, and there's so much happening here.
Yeah.
So
I think this is number 5 since like last fall, but yeah, definitely getting more regular.
yeah, and 3 in the last 3 weeks. So
Yep, this will be the third one this year, so
yep.
we're getting there.
Yeah, we're doing well. And again, we want to get you in and out in a reasonable time too. We're certainly sensitive of your time, but I mean, this is also your life's nest egg. This is aside from your health and I guess the love of your family, the most important thing. So maybe we shouldn't be so rushed. Let me know, what your, for these weekly videos, what is a comfortable view in time, for you guys. Maybe just let us know in our, your conversations with Kyle and I, or even want to send us an email. Would you like us to sort of stretch it out and get into the weeds, so to speak, or maybe that's once a month and then quicker updates weekly? Let us know what's comfortable for you. That'd be great. All right, and as always, Kyle, I tend to get on a roll. Kyle's a well-behaved Texas boy, so throw a rope or a lasso and interrupt me anytime you want. Okay.
All right, let's go.
All right, sounds good. Okay, so 3 things we're gonna hit here. Market update, Q4. We're now halfway through Q4 earnings season, and Friday we just completely after unbelievable earnings, which we're gonna talk about. We did a very intense market portfolio rebalance and reallocation. So you probably have saw those updated positions come through in your account. So we're going to hit all 3 of those guys. To start, markets are all-time highs. And the NASDAQ had made a new high prior to the S&P. The S&P is now at new highs, which, the early 2022 highs those are the targets. And now we are at new highs. The S&P is just shy of 5,000, which that's a hugely round, psychologically important number. And you'd have to think that the market wants to gravitate towards that. Kyle, on the research side, trading analysis, I was doing some math. Last week, if you look at the open interest, which means you can see option traders, you look at option chains of the S&P 500 options. So they trade options on the big S&P 500 index, which is what we track. And I netted out the buying and selling interest on puts and calls at the 5,000 strike in the February options. Okay, so there's a lot of technical there, but February monthly options at the 5,000 strike, you sum up the puts, sum up the calls. The net buying interest, last I checked, was about $10 billion. There was $10 billion notional dollars of more buy interest than sell interest. I mean, that's anecdotal, but it's significant. So, super round numbers like that tend to act like a magnet. Oops. So
Yeah, some optimism, and I mean, we were looking at that 4,800 as 4835 as a break point. I mean, that was
right.
something where at one point we would not have been surprised if it bounced back off. So it's a big move in the markets and prices.
And even to that point, I mean, you could even zoom in a touch. Now, you're looking at a chart, each one of these white and blue bars. And again, if you're investing with us and you don't really pay attention to the nitty gritty, gory detail we get into, that's completely fine. But you can see this is the NASDAQ. The initial approach to that old 48.35 level that Kyle just mentioned, you backed off for 2 weeks, and then we just pushed through, right? That's the S&P, and then the NASDAQ, kind of the same thing. The old significant high from 2022 in the NASDAQ 100 was 16,765. Got above it that week, sold off, and then we mounted another attack, and now we're through it. So really, we did get a week or two of sort of messing around with those all-time highs. Now, okay, so the big move that we saw was Powell this weekend on 60 Minutes. Basically, he was saying you need to be patient with us in terms of rate cuts. Kyle, were you watching 60 Minutes this weekend?
I missed it. I got the quotes.
Yeah.
General vibe.
Right.
And we could have done this. I think we did this press conference last week with us saying it wasn't going to happen. The cuts weren't going to happen.
This is very rarely. It's not my style on the wealth management or the research to be like, I told you so. But the market was investors were so excited and giddy about 5 and 6 interest rate cuts in 2024. And I said, there's no way this is going to happen. The economy is too strong. Earnings are too strong to get this. And then the realization that the markets are going to have to go through that process, that we're not going to cut rates, might be quite disheartening or disconcerting to investors. And so far it's been good. But Powell this weekend said, he's like, just be patient with us and expect fewer rate cuts than you might otherwise have expected. And markets, the chat this weekend on the social media and traditional media was quite negative. It would said we're going to have to see how these, just make sure that the monetary policy, which the Fed moves the short-term rates up to control inflation, calm it down. He just wants to make sure they have inflation licked, so to speak, right? And then Friday, before that 60 Minutes event, non-farm payroll came out. So these are the monthly jobs readings for January. The expectations were 187,000. They came out at 353, like a huge beat. And one of the big concerns for the Fed is inflation sourced from a very tight labor market. Unemployment rate is extremely low at 3.7%, right? So there's pretty much everyone who wants a job, is searching for a job, has a job. And then the kicker for the Fed was average hourly earnings. So tracking how much employees are being paid, expectations for month over month or an increase of 0.3 came in at 0.6, double. And then if you look at the same period, you look at a year ago increase, they're looking for 4.1. It came in at 4.5. So people are making more money. If people are making more money, they're out spending more money. They're pushing prices up. And the Fed wants to cut rates, provided that inflation is they have concrete evidence that inflation is off, is lower, and it's going to stay down. And Powell just said, hang on now, right? So the move was looking at the March meeting where the Fed sets their interest rate policy, which, that's the level of interest rates is set by the Fed in the short term on, shorter term interest rates, which do have a lot of trickle through, pass through effects to other key interest rates in the economy, like home loans and auto loans and credit card loans and any floating rate loans. Like that's really the key thing in the economy. And so, the cheaper money is to borrow, lower interest rates, more people are going to borrow and invest and stimulate the economy. Or 2/3 consumer spending, which is 2/3 consumer spending for GDP. So the point is, to wrap this little rant up, right now we're at 5.25 to 5.5% is the current Fed funds rate. That's what the Fed is setting the rate. A month ago, on January 5th, there was a 31.9% chance, according to the Fed funds futures markets, that we weren't going to be there. We were going to cut. 64% chance we're going to cut 25.25, and then a little 4% that we're going to go down 0.5. So it was basically, 70-30 that we were going to cut. Well, now it's 31. Then it went to 52% a week ago, then 80 yesterday, and then today it's 85% chance that we're going to stay on hold in March. So the March rate cut got pushed out. The May rate cut, we were at 11% chance a week ago that we were going to be at the current Fed funds target. This is 2 Fed meetings out. Now we're at 38%, 36%. So, now they're starting to push back these Fed rate cuts, right? So I know there's a lot of stuff in here, and the market, again, so a lot of people will say that the market's rallying based on the idea that is going to cut rates. I have a different opinion, but Kyle, jump in anywhere you want to go with that.
Yeah, I wouldn't expect any cuts until we see maybe some unemployment go up or some price stability concerns like we had, through like October of last year when they did cut rates. And part of that had to do with inflation too. And that's always the one, the kind of the X factor. But if you look at the economy, if you look at unemployment's still low, price stability is really good. I think it adds up with what we've been seeing, which is, probably what we should have been expecting is the no rate cut in anytime soon.
Yep. And that's the realization that the market is going through. So the one bad thing, if the Fed is not cutting rates, it's because one, nothing's broken right now. There are several technical reasons that we've addressed in last prior videos where we looked at the internals of the Fed's ability to service the debt if they keep rates high, if they have to refinance 10, 15, 17 trillion in their debt at these higher rates, what's that going to do to their their budget deficit and all that. I mean, there's factors, and Kyle and I have deep dived into those. But right now, the sort of the reaction that's happening to the Fed pushing back these rate cuts is interest rates, and specifically the long end rates. So when the Fed moves the short-term rate, it impacts the 2-year, 1-year, 6-month, 3-month Treasury yields. Okay, it's called the short end of the yield curve. The long end, more like 5s, 7 years, 10 years, and 30 years, are more determined by free market trading. Okay, so the Fed doesn't have that much of an impact on the long end, but regardless, the 10-year yield in purple here has moved up. All right, so that's the scale way over here. We're at about 3.85 or so, and we did get back above 4. We're at 4.1, 4.15 now. Now, what that means is because Powell said, don't get so, don't be so sure of a rate cut. Rates went up. Now, this is a little complicated, but if our interest rates go up, that means yields that can be made by international investors are increased. And if the rest of the world is not really seeing their interest rates go up, what they do is they sell so a Japanese investor is going to sell their yen. Like, a week ago I could get 3.8% in US, now I can get 4.2. So increasingly international investors, which is what they do, sell yen, buy dollar, and buy our higher yielding fixed income products. And if our stock market's doing well too, maybe there's another reason they sell yen, buy dollars to buy NASDAQ stocks. Okay, that's called the carry trade. Problem is, as that happens, as international investors are coming into the U.S., that drives up the price of the dollar. And that's the U.S. dollar here in green. Problem is, our big growth stocks, our multinationals, they have a lot of earnings overseas. They have to do an FX trade. And if the dollar's stronger, they're going to sell less foreign currency as as Apple's selling iPhones in Europe and China. They're taking money in renminbi, yuan, euro, and then they have to do a FX trade. And they should be bringing the money home. They don't always do it. A lot of times they leave money overseas. But the point is, the dollar's stronger, they're going to bring less earnings home. So that's why stronger dollar generally has an inverse relationship. It negatively impacts U.S. stock markets. Stronger dollar is generally bad for U.S. stocks. So by Powell saying that, pushed up our yields, pushed up the dollar, Generally, it's putting a little bit of pressure in the stock market, but I think the stock market handled it really, really well today. Normally, as you can see, look, 10-year yield is going up. The dollar's going up. What's the stock market doing? Going down. So you could see long-term going all the way back to 2023. There's generally an inverse correlation between the S&P 500 and U.S. yields and the dollar. It's not perfect. I mean, it fluctuates back and forth, but you can see pretty much since the end of 22, it's been inverse. Yields, dollar together, opposite of the S&P. Okay, so let's talk about seasonality. So we talked about this, Kyle. We talked about January effects. So really good book. I was just talking to my buddy Jeff Hirsch, who he took over Stock Trader's Almanac. I think I sent one to Kyle. There you go. You got it. There you go.
Right. There we go.
There you go. If you want to be here, let's throw that right back. This will make Jeff happy.
Yeah. Shameless plug.
There you go. It's really fun. It's a really well done publication. Just like the Farmer's Almanac, this Stock Trader's Almanac, and his dad, Yale Hirsch, came up with this back in the 70s. And Jeff is, I just was in the city with him last week or 2 weeks ago and reviewing the January effect, and they brought this to light. So as goes January, so goes the year. And we've talked about this. Every negative January preceding an extended correction, flat market, or a 10% drawdown without exception. Okay, so the direction of January does have a tendency to dictate the rest of the year. And here are the numbers. S&P was up 2.31%. And this was after a really bumpy first 5 days. And the first 5 days is also a stat they watch. We were down in the first 5 days. I was like, uh-oh, here we go. But we finished up 2.3 in the S&P and 2.8 in the NAS. So very good. So that is a good omen for the rest of the year. And getting a little technical here, I had fun putting this one together, Kyle. This was the candlestick. And again, those of you who don't follow the craziness that we do, candlestick is going to give you 4 pieces of pricing data. The lower left part of the body is the opening price of a particular period. The upper right part of the body is the closing period, the closing price of this period. And then the lower wick here of the candle is the low price, and the upper wick is the high price. So you have open, high, low, and close for a particular period, and these are monthly candles. And what I was seeing is, okay, this is actually what the S&P 500 January of 2024 candle looked like. And we know it was up 2.3%, opened here, closed here. So I was looking at other Januaries, and I said, okay, well, let's look at the January 2023 candle. It looks almost exactly the same. And then the other one was 2019, similar, kind of missing a little bit of an upper wick here, but still a very similar looking candle. Just very anecdotal. I thought kind of fun, but the last 6 years January effect worked 3 times. 18 it didn't work. 2019 it worked. We were up. 2020 didn't work. 2021 did not. 2022 it did, and 2023 it did. So just kind of putting that out there. I thought that was fun. Seasonality. So what we're doing is looking at the NASDAQ, S&P, 10-year treasuries, the dollar, crude, and gold. And we'd like to know historically where the markets are in each month. Seasonally, January is very strong. The NASDAQ on average going back from 1991 to 24 was up this amount. February is a down month on average. So just got to keep that in mind. And in fact, it's the second weakest month, the weakest being September. S&P is also a down month historically. So it's the second weakest month as well. Now, the other thing that's going to drive that home is treasuries are going back from 1983 to 2024 are also down. Remember, if the treasury price is down, that means the yield historically in February is up. And remember, I showed you in the last chart where if yields go up, generally the dollar's up and the stock market's down. So we need to watch some February weakness seasonally. Okay. Dollar's also up in February, not quite as much as January and May, but it's up. And as we know, yields, dollar generally work against the stock market. Crude is down generally actually it's up in February, and gold is up in February. So we're fighting some seasonal weakness in February, just something to keep in mind. This is more technical stuff that we do. And, I thought this was really interesting. Generally, what technicians do is we'll look at moving averages, right? So the thick dotted one is the 200 period moving average, and the gray one is the 50 period moving average. All it's doing is taking the average closing price of the last 200 weeks in the case of this weekly chart, or the last 50 weeks on this weekly chart. So what's the average price? Okay. And you can clearly see the moving averages are moving up, which means the average price of the preceding 200 periods is up. And what we like to do is look at how far or above or below the index, the S&P in this case, gets to compared to the moving average. So this is the percent distance in blue from the 200-week moving average. And I would, on first blush, Kyle, I would say, wow, we're pretty overbought. And I think a lot of people would say that. Just looking at the distance between the dash line and the S&P, say, wow, we're pretty overbought. But if you look over the last, I'm going back to 2010 or so, the periods at which the price of the S&P is stretched compared to the 200 period, the 200-week moving average, is about 33% above back in 2012, 13, 14, 2018. Heading into COVID, look how much higher the S&P was to the 200-week. And then the most extreme was post-COVID up here in 21, where we got 45% above the 200-period moving average. We're only at 21 now. So we're not at 33, we're not at 45. So based on that technical measure, market didn't get very extended. I don't know. I'm a technical geek, Kyle. I kind of enjoy that stuff. But
yeah, makes sense.
But again, it's sort of just eyeballing. I'd be like, oh, we're pretty overbought. Look at the distance from the moving average, but we're not even halfway there. So it's not appropriate on the 200 week to say we're overdone. The 50 week, you could see the gray line. 50 week gets 12, 13, 14%. I didn't put the figures in there. That one got a little closer to being overbought. It's not quite up to the 21 periods, but that one's a little bit more overbought. So I just wanted to put that one in front of you. Consumer confidence, Kyle.
Yeah. So going on, continuing on our last video, just looking at consumer confidence. We'll look at some of the earnings from some consumer stocks in a second, but we got another index or survey result showing the continued rebound in the consumer confidence. So this was for January. It's the highest read since December 2021. So kind of a confirming survey for what we're seeing in the earnings, which we'll get to in a second with Facebook, Netflix, some of the things that people are out there spending their money on. So just a good positive sign.
Nice. Yeah, consumer confidence definitely bouncing back. But I would say, just like that moving average study, Kyle, nowhere near overly optimistic. I would say it's with the market at such high levels at new highs, we're a ways away from all-time highs in consumer confidence.
Yeah, people are definitely still cautious. No question.
That's really interesting.
That 62% people thought, remember the one from last time? 62% of people thought we were heading into recession.
Right.
It's not in this slideshow, but yeah.
Same message.
Yeah.
I mean, that only if people are still that cautious, they're not going to be that cautious and be fully in the market, especially coming off of the highest interest rates we've seen in 3 or 4 decades. Like, there's still going to be money that is unallocated in the stock market based on low consumer confidence. And as you said, 2/3 of investors out there still expecting recession. And you and I uncovered 2 or 3 weeks ago that even though there's a lot of people out there pounding the table on recession, the 12 and 24 month returns after we yield curve triggered recession, they're still positive. So
Right.
anyway,
And then that the tons of money on the sideline. I mean, how many are in money market?
$6
Seven.
trillion
I don't
right
want to.
now.
Yeah,
Six
$6
point
trillion,
six point
which
one.
is way higher than it has been historically, for
Yep.
sure.
Yep. And that's not even in. I mean, that's not even in higher yielding, treasuries and like that's just like in like CDs,
Money market,
money
right?
markets.
Yeah.
Yeah. So interesting. All right, so we're halfway through earnings season. This is coming from John Butters of FactSet. Wonderful free resource. I put the URL right there. He's really does nice work. This was as of today's the 5th. Yeah, he published this today. 46% of the companies, the S&P reported results for the fourth quarter of 2023. Of course, this is Q1 of 24, so we're getting earnings from the fourth quarter of 23. 72% of the companies have beat earnings per share estimates, which is below the 5-year average of 77% and below the 10-year average of 74%. Okay. So on average for Q4, 77 to 74% of companies are beating expectations. We're at 72 right now. Okay. So yeah, 72% of companies are beating analyst expectations, but he goes on to say that a lot of that has to do with financials that largely have reported, and we're getting more and more tech and communications and consumer discretionary and industrials who will probably bring that aggregate up. And he says, however, it should be noted that since January 19th, 75% of the companies have reported EPS above estimates. So we're starting to get that up to a more historical, average, which, again, 62% of people going in expecting us to go into recession. 3/4 of companies are beating analysts' expectations. That's generally a good thing. And what we're looking at here is the growth rate today versus prior. Sort of John has given us this January 19th before and after, but we're looking at the earnings growth being led here in communication services, consumer discretionary, utilities, which is interesting, and technology. Okay, and then the laggards are energy, materials, healthcare, and financials. So let's look at Amazon. Let's turn to earnings. Amazon just absolutely crushed earnings, and the market was looking for 81 cents a share, and they reported $1. So that's more than a 20% beat. Increase in what they actually reported earnings compared to the street. Revenues were 169.9, expectations of 166 billion, 149 billion of the same quarter in 2022. I did an article for CNBC, and I'm doing an article every week for Pro. It's behind their sort of paywall, so it's not out there in the public. It's for people who pay. And I was making the point in the article here. I just took I just pulled out some of my text. The big metric that Wall Street was looking at going into Amazon earnings was the advertising spend that companies are buying on Amazon Prime videos. Amazon Prime has got unbelievable amount of people. I think I have the metric in here somewhere. It's crazy, but it's growing very quickly, and specifically their Prime Video area is growing. It's growing faster than the so-called AWS, which is their Amazon Web Services, which is their cloud component. The big leading indicator that many analysts and many traders look for is advertising on Facebook for small and medium-sized businesses, advertising on Netflix, and now advertising on Prime Video, because if the consumer is viewed to be slowing down, heading into a recession, ad buys for companies wanting to advertise will go down. Okay, so the advertising segment right here, as I wrote, Street is looking for 81 cents on this, a big boost to the advertising segment after the induction of ads to its quickly growing Prime Video and Prime Membership segment. Advertising segment is growing at 26%. That should be Y over T. I have an editor, and they edit my stuff. So year over year, 26% ad growth, which is faster than their cloud service. And then what happened is the advertising sales came in at 27% above, where they were looking for 26. So, that is confirming what Netflix said, which their new ad tier they put out there also beat expectations. So companies are spending on advertising because they view the consumer as strong and they think it's a good investment. So Amazon was a really good one for us. As Kyle wrote this for us, cut its staff, increasing efficiency. What are you saying? Highlighting the sector's climbed down from an era of rapid expansion as AI tech increases institutional efficiency. Nice sentence there, Kyle. I like that.
Yeah. So what we've seen in a lot of the tech companies within the last year or so with cutting staff, Amazon's doing it. And I think this is, you'd look at AI, not to go off topic, but I think we're going into that with all the sectors in the next couple of years. The tech companies figure out the AI, they figure out how to scale and be efficient with it, and then you see it go into the other companies that aren't technology.
It's applicable. These technologies are applicable to most industries. It's going to unfortunately reduce the head count. It's going to increase the efficiency, increase the margin, increase the earnings. I mean, that's the reality that we're going into for sure.
Yep. Probably a matter of time.
Yep. Yep.
And the ads, I don't know if do you use Prime Video?
I don't really. We use Netflix, but I don't use Prime Video. Sometimes I have it. Do you use it?
Sometimes. We watched something the other day and it wasn't very bad. I think it was 2 ads through the whole hour show or whatever it was. So it wasn't like intrusive, but
interesting.
I think they're charging $3 a month to get rid of them too.
Yeah. I don't think it's a very aggressive tier, but yeah, it's interesting. So we hold a 5.5% allocation in Amazon, and we increased it 1.5% in the November rebalance. Now, I did mention specifically in this CNBC article that technically speaking, we are looking at a zone of resistance from 165 to 170. We did trade up to about 172 after hours if the earnings, and we did back off at the close today. So I'm watching that. I think we closed at about 168, 169. So it's been a very, I'm glad we increased our allocation in November. It went up quite a bit, but I am very cautious and cognizant. I'm just checking where it finished today. I'll come back to that here. AMZ, my trading computer's behind me.
170.29.
170.29. There you go. So we closed right at the zone. So we're just going to be watching that in 170 in Amazon, but a really, really nice quarter, and that's fine. There's a lot going on here. Meta was a blowout, just an absolute blowout. Expected 494 earnings, and they came in at 533. Revenues looking for 39 billion, made 40 billion, and they guided higher. They're guided to 34.5 to 37 for this quarter we're in. Prior was 33.7. They also announced their first ever dividend. So 50, it's pretty unbelievable. And they're also doing stock buybacks. And, a couple interesting quotes coming from Zuckerberg. He is fully embracing AI. They ordered a ton of these new H100 chips from NVIDIA. This is Zuckerberg quoting, moving forward, a major goal will be building the most popular, most advanced AI products and services. If we succeed, everyone who uses the service will have a world-class AI assistant to help get things done. Our expectations generally, we need to invest more and support our AI work in years ahead. We're seeing some of that reflected. So Meta was coming off of what they call the year of efficiency. They cut headcount. They're fully jumping in the AI, much higher powered computing powers that we have. that was like an Austin Powers quote right there. But it's pretty amazing what the stock has done as we're now at new all-time highs. We have a fairly large allocation, 7% in our tactical alpha growth. So that served us quite well. We obviously couldn't hold it in our dividend, which is SIG, strategic income and growth, because it didn't pay dividend. Well, now it does, and we have added it. So really interesting move in Meta. Also, AMD, Netflix, and Apple. Netflix had a very, very good earnings report to kind of kick off Q4. We have a 3% there. AMD has been doing great, right alongside NVIDIA with 4% there. Apple, they've had some slowing revenue growth, and we've reduced our position there. But still a core holding, but we have reduced our overweight exposure. And I would say, sort of related to this AI and VR move, I think the reception of their new Vision Pro has been really, really good. I mean, people were laughing it off when they first announced it, especially at that price point. Now, Kyle, half the stuff we see on social media is people in the new Vision Pro. Have you noticed that?
Yeah, it just hit my social media today where I was seeing the videos of people walking around with the goggles on.
Listen, I think it looks awesome. And I've been very, very bullish on this. I think this is the way we're going. Whether we're wearing these big blocky things on our face or not, I don't know. We're all laughing at it. But I don't know about you, but when I first saw the AirPods, the white ear things hanging in everyone's ears, I'm like, you guys look so goofy. It took me forever to get on. You thought the same thing?
Yeah, same. I'm not an early adopter with the new tech. Usually.
I'm not. I thought they looked goofy for 2 years, and now I just look at now they're just a part of life. I don't even think twice about it.
Now I'm like, where are they? Yeah.
And it took 4 or 5 years for those to gain traction in Apple. I don't have those numbers handy, but the amount of AirPods they're selling are massive.
Yeah.
Trish, for my birthday, Trish got me the AirPods Max. I don't know. I don't know the deal. I'm sure I'll figure out, what the big deal is.
Soon they'll come with the augmented reality shades, something with them.
I guess. I don't know, but
Yeah.
I think, whatever shape or form that we'll be wearing these, we'll get used to it, and it'll probably evolve over the next couple of years. But now we're all laughing at it. But the same thing happened with AirPods, and now everyone has them.
Yeah, and like the watches, the smartwatches. I mean, people, you're like this. You're like we are. We have our set ways, But then you just one day you look at it, and you're like, this is way easier. This is way more efficient. Like this provides this utility, this benefit. Why? And it's like one day it just becomes a no-brainer, the new tech. And you don't even,
I'm sorry to interrupt. I sit behind a bunch of monitors, to look at all the markets and all the stuff we need to look at. With these things, literally, I'm going to put it in VR. I'm going to have, you're up there. I'm talking to you. I'll have this screen here. I'll have economic data here. I mean, it's just, you could sit here with your laptop and just everything is out. Everything you need's in front of you. It's amazing.
The video I saw, I literally saw the first video of people just out wearing the goggles today, and there's a guy in the subway, picking things out, and you can see him typing almost. Maybe he was typing. It's crazy.
It's so crazy.
In the air typing.
Yeah, I saw one example, somebody's cooking Thanksgiving dinner or something, and it's keeping track of cook time, and I don't know if it's watching the temperature. It's telling you what the steps are. It's just telling you what to do as you're wearing the goggles. It's pretty cool. So, but that's
crazy. I could use that one. Feature.
It's pretty awesome. I mean, this is what we're moving towards. I'm not surprised. So, we are in a technological boom period. So, anyways, back on track. That's it. We are going to roll into. We're going to roll into some specific portfolio updates. Obviously, we have to reserve that for clients. We did a big rebalance. We're going to go through changes we made, and we're going to leave that for clients. But thank you for watching, everyone. I appreciate it. Check us out at Inside Edge Capital. Kyle, thanks so much, man.
Thanks.
Okay.